Imagine you have $1,000 and trying to figure out what to do with it. It's definitely significant money to spend it all at once and splurge, but is it significant to invest?
The truth is, $1,000 is a great place to start investing and can make a difference in your financial health. In today's video, we're going to discuss several ways you can invest $1,000, which will help you decide which option may work best for you. Some investments might offer greater returns, but they also come with greater risk. If your financial safety net allows for this risk, such investments are worth considering. The first option is to build your emergency fund. An emergency fund is crucial to your financial health. When you are facing unexpected expenses such as a job loss, medical expenses, or surprise home or car repairs, your emergency fund will keep you from straining your budget or going into debt. Experts generally recommend having between 3 to 6 months worth of living expense in your emergency fund. If you're not quite there, $1,000 can go a long way. A good place to park your emergency fund is a high-yield savings account. This way you will get a guaranteed returns in the form of compound interest. Some high-yield savings accounts are now offering around a 5% annual percentage yield, a return which we haven't seen since the 1990s. Plus, these accounts are usually FDIC insured, so they are virtually risk-free. Option number 2 is to pay down your debt. If you have a credit card debt, paying it off should be your priority, especially in a high-rate environment. Let's say you have a $1,000 balance on a credit card with a 20% APR and only make a minimum payment of $25 each month. The balance will take you 67 months to pay off, and you lose $661 to interest. Or you can pay the whole balance off instead and not worry about interest charges at all. If you owe considerably more, you may feel as though $1,000 would barely make a dent in your credit card debt. In that case, you may also want to look into a 0% intro APR credit card or debt consolidation loan to save on interest charges. Option number 3 is to put it in a retirement plan. Another aspect of your financial life you want to cover is your retirement funds. If your employer offers a 401k match, you may be missing out if you are not taking full advantage of it. Further, it's a good practice to save 15% of your annual income for retirement, including any contributions by your employer. If that seems like a lofty goal to you at the moment, contributing $1,000 can definitely make a difference. If you don't have an employer-sponsored retirement plan, you can always invest in an individual retirement account (IRA) instead. The option number 4 is to open a certificate of deposit, which is usually called CD. Let's say your emergency fund is in good shape. You're on track to contributing to your retirement plan and you have no high interest debt, yet you'd rather not take on risk when it comes to your money. In this case, you might want to look into certificate of deposit. This type of deposit account earns a fixed interest rate for a specific amount of time on the funds you deposit when you open an account. The term lengths typically range between 3 months and 5 years. Longer terms tend to come with higher APYs, but with traditional certificate deposits, you can withdraw your money before the end of the term. Otherwise, you'll generally have to pay an early withdrawal penalty. Interest rates on CDs are often higher than those on regular savings accounts. This means you might get better returns at the trade-off of no easy access to your cash until the maturity date. But if you already have an emergency fund parked in a more accessible account, putting extra money aside in a CD can be a good move. Fifth option is to invest money in money market funds. Money market funds are for those who are not comfortable with investment risk but want to earn some interest on their money. Money market funds invest in lower risk debt securities such as US Treasury bills and commercial paper are considered some of the safest investments. Money market funds pay monthly dividends. The yield is typically close to or little higher than bank savings accounts. This is also a highly liquid option. You can withdraw the money you have invested at any time. You can buy a money market funds from a bank, fund providers such as Fidelity Investments or Vanguard, or by opening a brokerage account. The sixth option is to buy treasury bills. Speaking of treasury bills, they are also a low-risk investment since they are backed by the government and give you a guaranteed return over a set period of time. You will get a nice guaranteed rate dependent on how long the maturity is, assuming you hold until the maturity. and you will not owe state income tax on the interest. Since there is a maturity period, this option provides less liquidity than money market funds. At the same time, the term can be very short, from just few days to a year. You can buy treasury bills directly from the Treasury Direct website or go through a broker like Charles Schwab or Fidelity. Option number 7 is to invest in stocks. If you don't mind parting with your $1,000 for a while for a chance of high returns at high risk, consider investing in the stock market. The best ways to invest in stock market is through stock index funds, then picking individual stocks. These investment funds follow a benchmark index such as Nasdaq 100 or the S&P 500 index. The money you invest in such a fund is then invested in all the companies that make up the index, which allows for a more diverse portfolio than you would get buying in individual stocks. This is really a great option for those with a long time horizon. Through this, you'll get good stock market diversification, low costs, and likely no trade fees. You can invest in an index fund if you have a brokerage account, a traditional IRA, or a Roth IRA. Many popular brokerage accounts in the market don't charge a commission fees for the account, and some provide access to fractional shares, which allow you to purchase a portion of a stock that's less than one full share value. Option number 8 is to use a robo-advisor for investing. Robo-investing is the best option if you're interested in investing but want a more hands-off approach. You can use robo-advisors, which will automatically invest in several index funds and ETFs based on your goals and risk tolerance. These accounts typically have low or no minimum opening deposits and have much more affordable management advisory fees than traditional financial advisors. You don't really need to wait to have thousands of dollars to start investing in banks, certificate deposits, high yield savings account, or even in stock market. Even just $1,000 can go a long way if you make it benefit your financial well-being. Whether you're at the very beginning of your financial journey, paying off your debt and adding to your emergency fund, or you're ready to start investing in stocks, even a small initial contribution can help you lay the foundation for a prosperous future. Once you start the investment process, the combination of regular contributions plus investment returns will grow your portfolio substantially over time. You don't need to wait until you have many thousands of dollars before you're taking the first step in investing. You can just start investing today. Use the options we discussed today to get started with investing as little as $1,000. If you like this video, subscribe to our channel so that you don't miss any of our videos on personal finance and you get notified.